Hello, my name is Todd Elpervitz and welcome to Outstanding English. In today's video, we're going to explore some useful vocabulary terms about stocks and the stock market. You may find this video helpful if you are currently investing money in the stock market, but have never used English to talk about the subject, and you may find this video helpful if investing money in the stock market is completely new to you. While you're watching, have a notebook ready and write down any words and definitions you aren't already familiar with. Please note that in this video, I'm going to introduce vocabulary items and I'm not giving any financial or trading advice during this video. There are a lot of resources out there, such as books and websites for beginner investors, and I highly suggest you do some research before investing any of your own money into the stock market. So let's get started. A stock represents the ownership of a fraction of a corporation. A stock is a security which is a financial investment with some monetary value that can be traded. Units of stocks are called shares. Shares of stocks are bought and sold predominantly on stock exchanges. Stock exchanges are the centralized locations where the shares of publicly traded companies are bought and sold. One example is the New York Stock Exchange pictured here. To buy stocks, you need to go through a broker. A broker is someone who buys or sells an investment for you in exchange for a fee. Nowadays, we have online brokers such as Ameritrade, Robinhood, and Webull, and a few others that offer robust trading platforms and $0 trading fees. When you are looking for a company to invest in, you will look up its stock symbol, which is also known as a ticker symbol. This is the arrangement of characters representing a publicly traded company. Here we have the stock symbols for Tesla, Pfizer, and Microsoft as examples. And to know how much money each share is, you need to see its quote. A quote is the price of a stock at any given time. Your portfolio is your collection of investments. A bid is the price you are willing to pay for a stock, and the ask is the price people selling their stocks are willing to sell at. A bid-ask spread is the difference between the ask price and the bid price. Typically, a stock with a narrow bid-ask spread will have a high volume of demand, and a stock with a wide bid-ask spread will have a low volume of demand. Execution is when your buy or sell order has been completed. This is when the order has been filled and you are now the proud owner of the stocks that you've set out to buy or now have money for the stocks that you've sold. There are different types of orders that can be placed. A market order is an order to buy or sell a stock immediately. A broker will execute at or near the current bid price for a sell order or at or near the current ask price for a buy order. Alternatively, you can place a limit order. A limit order is an order to buy or sell a stock with a restriction on the maximum price to be paid if you are buying or the minimum price to be received if you are selling. A good till canceled order is an order to buy or sell a stock at a certain price that lasts until the order is completed or canceled. A day order is an order to buy or sell a stock at a certain price but expires at the end of the trading day if it is not completed. A stop loss order is an order placed with a broker to buy or sell a specific stock once the stock reaches a certain price. So if you bought a stock at $20 a share but can't stomach losing more than 10% on your investment, you would place a stop loss at $18. This would trigger if the price dipped down to or below $18 a share. One version of the stop loss is the trailing stop loss, which is a risk management tool. Instead of remaining at a specific price level, a trailing stop loss follows behind the price when it moves in a favorable direction. To average down is to buy more of a stock as the price goes down. This brings your average price per share down. For example, if you buy 50 shares at $10 a share, but the price dips down to $8 and you buy 50 more additional shares, you have averaged down your price per share to $9 a share. This lowers your break-even point. Now let's talk about different traders and investors. A retail investor is an individual or non-professional investor who buys and sells securities through brokers or savings accounts like 401ks. Day trading is the buying and selling of the same stock during the same trading day. A person who engages in day trading is called a day trader. You need to meet certain account requirements to day trade, Otherwise, you are limited to no more than 3 day trades in a 5 trading day period. Swing trading is buying a stock and holding it more than a day to several months in order to profit from an anticipated price increase. Someone who swing trades is called a swing trader. Now let's talk about different types of stocks. Blue chip stocks are huge, stable companies. These stocks tend to be less volatile, means they go up less and go down less. These include, but are not limited to, Apple, Coca-Cola, Johnson & Johnson, Disney, Walmart, and Procter & Gamble. Before we go on, we should talk about capitalization. Market capitalization is what the market thinks the value of a company is. To find this, you multiply the stock's current price by the total number of shares. Here's a list of the 25 biggest companies in the United States based on market capitalization. In the United States, large cap stocks are companies with market capitalizations of $10 billion or more. Mid-cap stocks are companies with market capitalizations or market caps between $2 billion and $10 billion. And small-cap stocks are companies with total market capitalizations in the range of about $300 million to $2 billion. A meme stock refers to the shares of a company that have gained a cult-like following online with retail investors through social media platforms such as Reddit and Twitter. I'll have more about these in our follow-up video. OTC or over-the-counter stocks are those not listed on a major exchange. These are instead traded through a broker-dealer network. These are typically smaller companies and do not meet the requirements to be listed on a formal exchange. A sector is a group of stocks in a similar industry, such as the tech sector, the energy sector, consumer staples, and others. You can look at a market heat map like this to see how the overall market and individual sectors are doing. On this particular day, things weren't looking so good across most of the market. Mutual funds are regulated investment products offered to the public and available for trading. These have minimum investment requirements, and the money of investors are pooled and the funds are actively managed. ETFs or exchange-traded funds are a collection of securities that track an index, a sector, a commodity, or another asset. So instead of buying an individual stock in an individual company, you are buying a collection of stocks all at once. They are similar to a mutual fund, but they are passively managed, and the only minimum investment is whatever price per share that particular ETF is trading at. ETFs can be purchased or sold like a stock. Examples of index ETFs include the Vanguard S&P 500 ETF VOO and the SPDR S&P 500 ETF SPY. These track the S&P 500 and mirror its movements very closely. Hedge funds are private investments that are only available to accredited investors. Hedge funds are known for using a higher risk investing strategy with the goal of achieving higher returns for their investors. A bull market is a market in which the share prices are rising across the overall market. You can use the adjective bullish to talk about the market or a stock. So you could say the market was bullish last week. In bullish conditions, you'll have a rally, which is an increase in prices in the overall market or an individual stock. A bear market is a market in which the share prices are decreasing across the overall market. The adjective for this is bearish, and you could say investors turn bearish over the news of a stock split. Volatility is how fast stock prices are moving up and how fast they are moving down. Volatile markets have wide price fluctuations, big ups and big downs, and heavy trading. A stock's liquidity refers to how fast shares of a stock can be bought or sold without impacting the stock's price. Stocks with low liquidity may be difficult to sell and may cause you to take a bigger loss if you cannot sell shares when you want to. High liquidity means there are a large number of orders to buy and sell. This increases the probability that the highest price any buyer is willing to pay and the lowest price any seller is willing to accept will move closer together and the bid-ask spread shrinks. Trading volume is the total number of shares of a security that were traded during a given period of time. Unusual volume is when the shares of a stock are being traded at unexpectedly high levels. The public float or free float represents the number of shares of a corporation that are in the hands of public investors. Low float stocks are those with a low number of shares. A stock with a low float will generally be more volatile than a stock with a large float. Next, we have authorized shares, or authorized stock, which refers to the maximum number of shares that a corporation is legally permitted to issue as specified in its articles of incorporation. An IPO, or initial public offering, is the process of offering shares of a private corporation to the public in a new stock issuance. This is when a private corporation goes public. A secondary offering is called a follow-on offering. Companies may do this to raise money to pay off debt, to make acquisitions, to expand, or to fund research and development. A dilutive secondary offering increases the total number of shares, while a non-dilutive secondary offering do not increase the total number of shares. A SPAC, or Special Purpose Acquisition Company, is a company that has no commercial operations and is formed strictly to raise money through an initial public offering, or IPO, for the purpose of acquiring or merging with an existing company. Earlier this year, the electric vehicle company Lucid Motors was taken public via the SPAC CCIV, or Churchill Capital 4. A dividend is money paid regularly by a company to its shareholders. Not all stocks pay dividends. Margin investing is the practice of borrowing money from a brokerage firm to make investments. This has high risks and is definitely not for beginners. A moving average is a stock's average price per share over a specified period of time, such as a 50-day moving average and a 200-day moving average. Moving averages can be used to identify trends and potential support and resistance areas of a stock price. An ROI is a return on investment, or return on costs. This is whether you gained money on an investment or you lost money on an investment, how much you gained or how much you lost. In short selling, a trader sells a security first with the intention of repurchasing it or covering it later at a lower price, investing in such a way that the investor will profit if the value of the stock falls. A short squeeze happens when many investors short a stock or bet against it, but the stock's price goes up instead. If the stock's price rises too quickly, then short sellers have to close out their positions as rapidly as possible, thus causing a further increase in the price of a stock. Now you have a short squeeze. A trading halt refers to a temporary stoppage of trading. This can be due to anticipated news, or you may have a circuit breaker halt due to a dramatic downward fall in the price of a stock. A stock split is an increase of shares without diluting. For example, a 1-to-4 split. If you had one share at $200, you now have 4 shares at $50 a share. A reverse stock split is a decrease in the number of shares without diluting. For example, a 10-to-1 reverse split. You had 50 shares at $3 a share, and now you have 5 shares at $30 a share. Multibaggers are stocks that give returns that are several times their purchase cost. A two-bagger is a return of 100%. For example, a stock that you purchased at $10 and then went to $20. A three-bagger is a stock that rose 200%, so a stock that went from $10 to $30. And something wild like a 10-bagger is a stock that rose a 10-fold increase from its original price. A gap up or gap down occurs when the price of a stock opens above a gap up or below a gap down the previous day's close with no trading activity in between. And finally, a pump and dump is illegal and a form of securities fraud and involves artificially inflating the price of a stock you own through false or misleading statements that are positive in order to sell the cheaply purchased stock at a higher price. So a person takes a large position in a stock, he or she pumps the stock by creating a lot of false positive news about it so that other investors will drive the price up, and then the person exits their position or dumps their shares, and the price free falls as others quickly exit their positions. Thank you for joining me here at Outstanding English. If you found today's content helpful, hit that outstanding like button and don't forget to subscribe. See you in the future.